Hi everyone, today we're talking about accounting for transactions in a merchandising operation, and we're focusing on a perpetual inventory system, and we're looking at purchasing transactions. And of course, I'm your instructor, Brandy. So when we're talking about merchandising operations, we're talking about companies that buy and sell products. So good examples of these would be retailers like a shoe store, a clothing store, a grocery store, or a department store. Let's talk about the business cycle of a merchandiser for a second. How a merchandiser's business cycle works is the owner invests money into the company spends money to purchase inventory, and then they sell that inventory to customers. And hopefully they can sell it for more than they bought it for, making a profit. They then use the money that they made on selling the inventory to purchase more inventory, which then they will in turn sell and use the money to buy more inventory, and so on and so on. This cycle keeps going, and that is how they make their money. So when we're talking about the journal entries, obviously we have to purchase inventory before we sell any. So let's start off talking about the transactions for purchasing inventory. So under a perpetual system, we're always going to keep a running total of our inventory account. At the end of the year, we're going to perform an inventory count to make sure what's in our records matches what's actually in our warehouse, and we'll update our records if there's any discrepancies. So let's take a look at how this works. So this is a pretty simple transaction. Parker's Shoe Store purchases $1,000 of shoes and pays cash on May 1st, 2016. Because it's a shoe store, the shoes are our inventory. So let's do our journal entry. Our date is May 1st. Our debit is going to be to our inventory account. And this inventory account is an asset, and it would show up as a current asset on our balance sheet because we expect to sell our inventory within 1 year's time. Our debit is for $1,000, and we're paying cash. Our cash is decreasing by $1,000, so we are going to credit it. Let's expand our example. Parker's Shoe Store is now purchasing another $500 of inventory on account on May 2nd. So remember that this on account term means that we're going to pay later, which means we're going to be using the accounts payable, which is our liability. So our journal entry for this transaction will look like this. Our debit is going to be the inventory account. Our inventory is an asset and it's increasing, and our credit is going to be our accounts payable. And our description, and when the accounts payable is paid off, the transaction will look like it did before. Debit to accounts payable for $500 and credit to cash for $500. And let's start keeping track. Let's start keeping track of our inventory in its T account, so we can see everything that goes into this inventory account. On May 1st and May 2nd, we had purchases of inventory. May 1st, our inventory purchase was $1,000, and May 2nd, our inventory purchase was for $500. So let's continue on with our example of purchasing inventory. So now on May 4th, Parker's Shoe Store purchased $2,000 of inventory on account with the terms 2-10 and -30. Let's talk about these terms for one moment. These are what is referred to as discount terms. If we go back to our business cycle for one moment, you'll remember that merchandisers work by purchasing inventory, so they have to spend money, and then they sell that inventory. And in order to buy more inventory, they have to collect the cash from the inventory that they sold. So when they sell inventory, then collect cash, then they can buy more inventory to then sell, collect the cash, buy more inventory, sell, collect the cash, and so on. And it keeps going and going and going. So what happens if someone doesn't pay, especially if it's a large customer? If the company cannot collect the cash, there's a dramatic halt in the cycle. They can sell the inventory, but if they don't collect the cash from the accounts receivable, they don't have cash to buy more inventory, which means that they can't sell anymore to make more money, and the cycle stops. So when we're dealing with accounts receivable and accounts payable, it's in the best interest of the companies to collect the cash as quickly as they can. So when we're buying inventory, often suppliers will give us a discount for paying very quickly. So if we go back to our example here, that 2, 10, and 30, the first number, the 2, the first amount, the 2, is the company saying we're going to give you a 2% discount, the second number, 10, if you pay within 10 days. Then there's a comma, and then the N stands for net. So the net amount is due, or the full amount is due, within 30 days. And it always looks like this: percentage / days, comma, full amount / days. So we have Parker's Shoe Store purchasing inventory on account, and we have some discount terms. When we actually make the purchase, we ignore the discount terms for the time being. We actually take the discount into effect when we pay the bill and we know whether or not we can take advantage of the discount. So on May 4th, we're going to make the following journal entry. Debit to inventory of $2,000 and credit to accounts payable for $2,000. Okay, so now let's go update our T account. Let's continue on with our example. On May 9th, Parker's Shoe Store pays off the full amount owed from the May 4th purchase. Okay, so now we go back to the May 4th purchase, which is just above here. And on May 4th, we purchased inventory $2,000 on account with the terms 210 and 30. So you ask yourself, am I within my discount period? Can I take advantage of that discount? So we are less than 10 days after the point of May 4th, so we can take advantage of the 2% discount. And when you're doing a transaction that involves a discount, think about doing your journal entry in this order. The first step is going to be to clear out your accounts payable completely. At the end of this transaction, we have no balance owing in our accounts payable, so our accounts payable needs to go down to 0. So right now we have an accounts payable credit balance of $2,000 from May 4th. So we are going to debit accounts payable for the full amount and get rid of it. The second step is to figure out how much our discount is. So our discount is that 2% times our accounts payable amount of $2,000. So $40. And where this $40 goes under a perpetual system is we are always going to keep track of our inventory account. And anything that adds or reduces the cost of purchasing that inventory is going to go into that inventory account. So our discount is going to reduce the cost of our inventory. In order to reduce the cost of our inventory, we are going to credit inventory for $40. And the difference, 2,000 minus 40, is going to be to cash. And this makes sense because you are paying 98% of the original purchase price because we're taking advantage of the 2% discount. And don't forget your description. And because we are doing something in our inventory account here, we're going to need to update our T account at the same time. So let's continue our example further. So Parker's Shoe Store returns $400 of the merchandise or inventory purchased on May 1st. So remember, because we're under the perpetual system, we always have to keep our inventory account up to date. This means when we make returns to a supplier, we decrease our inventory account. So our journal entry is going to be May 10th. We're going to decrease inventory, so we're going to credit it. And the supplier owes us money back. So if we haven't paid for the merchandise that we purchased on May 1st yet, we could simply reduce our accounts payable to that supplier. In this case, we've already paid the supplier the full amount owed for our May 1st purchase. So they are going to owe us money. So we're going to use our accounts receivable. And we can also go update our T account. So that was a return transaction. Now let's deal with an allowance transaction. So on May 11th, Parker's Shoe Store realized some of the shoes they ordered on May 2nd are the wrong size. The supplier offers an allowance of $100 in exchange for Parker keeping the shoes. So this is different than a return because Parker's Shoe Store is actually keeping the inventory in its store, but they're essentially asking for an allowance, a discount from the supplier. So this is effectively reducing the cost of the inventory to Parker, and because we're under the perpetual inventory system, we are going to reduce the cost of that inventory account. Again, we've already paid for this merchandise, so the supplier now owes us $100. So we're going to use our accounts receivable account. And our credit is to inventory. And we can update our T account. So that's how you deal with purchases, discounts, return, and allowances under a perpetual system. Thanks for watching, everyone.